All right, welcome back to the Market Master podcast. So, as you can tell by today's title, we're going to talk about the one thing that the market cares about. So, what do I mean when I'm talking about the one thing that the market cares about? Well, if you go into any financial publication, okay, anything like the Wall Street Journal, Barron's, I don't know, Market Watch, Seeking Alpha, any of these things, you're going to come across dozens and dozens of articles talking about everything from, reasons why the market is going higher from here to reasons why the market is about to crash and everything in between. But like with basically everything in the market, 90% of it is just noise. 90% of the stocks that trade on the market are pure noise. 90% of the movements in stock prices in all of those stocks is just noise. And same with the articles, narrative, any news that comes out on any stock or the market in whole, 90% of it is just noise. But if 90% is just noise, that means that 10% is the signal that we're looking for. 10% of the stocks are what we're looking for, and 10% of the price action is relevant and important to us. 10% of the narrative or of the news that comes out is at least somewhat important. So then the question becomes, how do we find this 10% that is important or could help us in some way? And how do we know that it's important or that it could be useful to us? This is the really important question, and it's a very difficult one to answer because every single day, again, if you have the Wall Street Journal app, Barron's app, or something like that, you're going to get inundated with alerts throughout the day, especially, when the market's open. You're going to get alerts on different breaking news stories or, reasons for, the Dow Jones is up X percent today or XYZ is down this percent today. Here's why. You always get a breakdown of why things are the way that they are. But most of the time, this is pretty much bullshit. Stocks go up, stocks go down. But in looking over the last, 150 years of the market, both the individual stocks, the market as a whole, and looking at news flows on these individual stocks and the market as a whole, it becomes very clear that at any given time in the market, there's really only ever one or two things that the market itself actually cares about. And that's to say that I guess you'd say the short-term to medium-term performance of the market, either up or down, hinges on the outcome of one or two things that the market is focused on. Certain catalysts that can propel the market higher or lower. So some of these catalysts that I've been able to find, and this is not going to be an exhaustive list, but these are some things that keep recurring over and over and over. Okay, so some of the more important catalysts that dictate the movement of the market, in no particular order, earnings from big leaders. For example, we go back to my favorite period, the 1920s. So late 1924 into 1925, you had big earnings, surprise earnings reported from the auto manufacturers. And this led to a big rally in that group and made General Motors the big market leader that it became, and that propelled the market higher from there. Another example of these earnings reports propelling the market higher would be something like Apple in 2012. So if you look at January 2012, when Apple released its earnings, the market basically got caught off guard by that, and it helped push it forward for the next few months or so. The more recent example would be NVIDIA from 2023. So among the AI hype, when they announced the crazy earnings in 2023, it just shot not only the stock higher, but also the market rallied on the back of the AI hype surrounding NVIDIA. So after earnings from big market leaders, we have Fed moves. Okay, so actions by the Federal Reserve. Most of the time, it's going to be just Fed rate cuts, either cuts or hikes. Again, both positive and negative directions. And again, with all of these catalysts, like earnings and these Fed decisions. These are things that come out constantly, right? We get Fed rate decisions, every month or two. We get earnings every single quarter from these companies. So just because some company comes out with, big earnings doesn't mean it's going to propel the market higher, right? The same thing with Fed rate cuts or hikes, just because the Fed cuts or hikes interest rates doesn't mean it's going to have a huge effect on the market in the coming days or weeks. The biggest move you're going to see typically is just going to be, the closer you are to the actual announcement of that news. So like right when the Fed announces rate decisions, you'll see things react. But then if you zoom out on a larger time frame, most of the time you're not going to be able to pinpoint when these things happen. So part of this whole exercise in going over these catalysts is just to get you familiar with the type of catalysts that are quite common in the market. And then, there's going to be some more work beyond that as far as knowing when a certain catalyst is actually a catalyst. So we'll go ahead and talk about that a little bit more once I'm done with the rest of these. So moving on, we have government policy shifts. So in 1957, we had Sputnik, which basically caused people to panic and think that the Soviets now had the capability of putting nukes on these satellites and shooting them down on us from space, basically. And people freaked out, and the government basically ended up passing huge spending bills related to defense after that, which caused the market to surge higher, especially with any stocks related to defense, like rocket fuels was a big one, and automated systems, automation and rocket fuels, defense missiles, stuff like that. But even more recently, you have stuff like coming out all the time, right? Like obviously on the negative side, you have stuff like the tariffs in both Trump terms, 2016 and 17, I think you had the trade war. Both Trump terms, you had these trade wars, the tariffs, setting the market lower. That's a shift in government policy that affects the market. But then on the other side, you have Trump coming out with executive orders, or at least, reports that he's going to come out with some kind of frameworks for like nuclear energy, crypto, different policy shifts towards like fossil fuels, and negatively against stuff like clean energy, solar, wind, stuff like that. So government policy can be a huge catalyst in the market. I believe it's one of the most powerful catalysts in the market. Yeah, one of the reasons why government policy is so effective as a catalyst is because of its ability to not only create, but also to destroy entire industries overnight. For example, if you take a look at, these Chinese education, so stuff like EDU. Okay, if you pull up a chart of ticker EDU, and let's go back to 2021. Okay, if you take a look at that chart, what else is there? EDU, it's GSX, GOTU, GOTU, and TAL. Okay, so TAL, EDU, and GOTU. So you take a look at this group in early 2021, and you can see they got absolutely demolished. Okay, we're looking at average like 90% decline here. That is the power of a government catalyst. The Chinese government basically said that this industry was no longer okay in China. They banned private education, private tutoring or something. And it basically wiped out the industry overnight. Another example that would be in 1933, basically right when FDR got into office, he shut down banks and the stock market for, several days while they came up with some kind of economic plan to help stimulate the economy. And that was the very bottom of the Great Depression. Obviously, the economy wasn't great for the next however many years until World War II, but that was the very bottom. And you can see, if you pull up a chart of the Dow Jones, March 1933, and the market ran up like over 360% from FDR taking office to the peak in early 1937. The next catalyst that I've noticed we can call something like geopolitical shocks. In this category, we would have stuff like war, war breaking out, some kind of conflict between countries or within a country. So another example of this kind of catalyst was in late 1999 when China struck an agreement to enter the World Trade Organization. And this basically sent stocks that were already basically ripping, and it sent them basically stratospheric. If you can pull up a chart of the NASDAQ, so you pull up a chart of the NASDAQ NDX, you'll see the breakout in late 1999. It just goes straight vertical. Okay. It goes up over 80% in a straight line in, I don't know, like 3 months, 4 months. That was sparked by China entering the World Trade Organization, or at least agreeing to enter the World Trade Organization. Another geopolitical shock that we're going to talk about a little bit later, the Cuban Missile Crisis. Okay. So that would be another example, not exactly a war or something like, China entering the World Trade Organization, but along those lines in terms of, conflicts and agreements between nations. The next catalyst that we've got is economic data. This can kind of relate back to the Fed, their rate cuts, rate hikes and stuff. But economic readings, the unemployment stuff, inflation is a big one. Also things like GDP expanding or contracting more than expected. That can play another significant role. So with all that talk out of the way about the catalyst that can propel the market higher or lower, those are examples of things that are typically the one thing that the market is concerned about at any given time. Again, not an exhaustive list. There are definitely others, but these are the ones that continue to pop up over and over again. Okay. So with that out of the way, I want to talk to you a little bit about uncertainty. So Warren Buffett likes to say that bond yields tend to act like gravity on stocks. Okay, so as bond yields go up, so investors can get more returns for their lower risk investment in bonds, then it makes stocks less attractive. So they're incentivized to put their money into bonds more than into stocks. Okay, so that's why there's kind of this correlation between bond yields and stocks. So interest rates go up, stocks tend to drift lower. This isn't always 100% correlated. Like an example would be 1999. We all know the market was just completely on fire in 1999, and yet the Fed hiked interest rates 3 times in 1999, and the market continued to have an insane year. Piggybacking on that idea that bond yields act as gravity on stocks is the idea of uncertainty also acting as like a type of gravity on stocks. So when we talk about uncertainty, usually what we mean is uncertainty of positive future outcomes for businesses or the economy. Like in 2008, people were pretty certain that some bad shit was going down. That doesn't mean stocks are going to rise when they're certain of bad stuff happening, right? So normally when we're talking about certainty, it's certainty of having a medium-term positive outlook on the economy and in stocks as a whole. So typically, as uncertainty clears away and the market becomes more certain of a particular outcome, particular positive outcome, at least for the short to medium term, stocks tend to rise. And as uncertainty builds, stocks tend to fall. Okay. This is kind of one of the reasons why you see these post-election rallies a lot. It's not every election, definitely not every election, but there is definitely, if you go ahead and look at like an all-time chart of the Dow Jones, you'll see in these election years, there's very often a rally from very early or mid-November until the beginning of the following year. We've seen that. We saw that in 2020. We saw that this last time, right? 2024 with Trump getting elected. We saw it the first time Trump was elected, and it happened many, 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 many other times. A lot of times during these election cycles, it's not so much that the market is praising a particular candidate that wins, although that can happen as well, but it's more that the market is just glad to get uncertainty out of the way. So now they know how to invest in the market for the upcoming new administration. So all of these previous catalysts that I've mentioned all act as a source of uncertainty. And as these things develop, they reveal either more or less uncertainty about the immediate future of the market. Okay, so earnings, obviously, rate decisions, government policy shifts, geopolitical shocks, economic data, all of this stuff has a big role to play in creating and easing the uncertainty in the market. But sometimes you get these periods of like meta uncertainty, okay? Uncertainty about what the uncertainty is in the market, if that makes sense. These are periods where there's really no news to adequately explain a fall in stocks. Earnings could be at all-time highs. The economy could be humming along perfectly fine. Rates could be low. For some reason, stocks fall 10, 20%, and nobody has any explanation for it. One example of this is in 1962, we had something called the Kennedy slide. So in late 1960, after one of these post-election rallies, like we mentioned earlier, the market was up about 30% or so at the end of 1961. And in early 1962, JFK started to pressure steel companies about the recent price hikes that they had made. And this kind of started a cascading fear of the Kennedy administration getting more involved in a negative way with business. And it just kind of created a cascading side effect where the market basically fell nearly 30% from its peak in late 1961. And you can read newspaper articles on the Kennedy slide. People basically had no real explanation for it. They just blamed Kennedy for creating uncertainty in the market. And then there's also the usual stuff like, high PE levels, the market's just readjusting after a long upward period of advancement, the usual. Basically, no one could really explain the downward pressure on the market. It's just kind of one of those examples of periods where people come up with explanations after the fact, but during the actual event itself, people kind of shrug and just saying, I don't really know why things are going down, but here's that's kind of what was at play there. Then what happens is we get a sharp rebound. People realize, okay, the market's kind of, taking its course. The correction is overdone. They come back in, bid up stocks. And then this leads us into another correction into the Cuban Missile Crisis, which happened later that same year in October. So I'm not going to get too deep into what the Cuban Missile Crisis was. You can look that up if you're interested. But the short version was basically the Soviets had established nuclear missiles in Cuba that were obviously well within striking distance of the U.S. And it basically created huge panic about the imminent destruction of the world, basically. It's often considered to be the closest that we ever got to complete all-out nuclear war. Now, the funny thing about this is if you take a look at the Dow Jones average, ticker symbol, it's like $ and then DJI. Okay, you go back to late 1962 here, and the day that JFK was briefed on this incident, okay, when they got the intel about these missiles in Cuba, was October 16th. And that's pretty much like right at a turning point where the market, it was still in consolidation, recovering from the Kennedy slide, but it basically just immediately started another downward move from this day before the public knew. And JFK didn't address the public on this issue until October 22nd, I think. Let me see. Yeah. So JFK did not address the public about this issue until October 22nd. So the market slides more on the 22nd and the 23rd. But then, only a couple days after the announcement, you get the very bottom. The market bottomed on the 24th. And then on the 28th, Khrushchev agreed to move the missiles out of Cuba, officially ending the Cuban Missile Crisis. And what happened next was, the very next day was the start of a huge bull market that lasted from the end of 1962 all the way through the rest of the decade. And there was not a single, from this point, from the Cuban Missile Crisis. So basically, the beginning of November 1962 until May 1965, there was not a single market correction of 10%. For 2.5 years, there was no correction that even hit close to 10%. And that's not to say that once the Cuban Missile Crisis was resolved, that, oh, okay, that means that there's a new bull market that's starting. That's not how you would have thought about it in real time, right? We can always see that after the fact. But obviously, you should be looking for places to be putting your money on the resolution of these kinds of events, right? And then you just play it however it is your strategy tells you to play. And I think it can be something you want to look for is to use these kind of resolution days as a signal to potentially increase your bet size, because it is quite often that these resolutions in the market do lead to extended moves, not necessarily, like entirely new bull markets like the end of the Cuban Missile Crisis, but they can lead to pretty strong, 20% rallies or something like that, that last several months in the market. And if you're getting in on the start of a big move like that, with big size, that really compounds quite quickly. So another example of this meta type uncertainty would be the 1987 crash. Now, obviously, in hindsight, people have come up with explanations, of course, for it, blaming it on automatic portfolio insurance. You can go ahead and look that up if you're interested. Basically, as the market would slide down, people would automatically have these algorithms sell futures contracts. And it's basically created a cascading effect, whereas the market kept going down. These automated trading systems would sell the market down even further, just creating a huge mess and spiraling down out of control, right? But at the time, earnings were soaring, the market was ripping, stocks were on fire, everything seemed good, inflation was under control. But then you had this freak incident, and like every time the market takes a big hit, people were concerned about another Great Depression. It seems to be quite common, obviously, after the 1920s and 1930s. Every time there was a fall in the market, people would be warning of the next Great Depression. Or anytime stocks were on fire, they'd be warning of excessive speculation. But then this also plays into the resolution of this event. Okay, so 1987, the market crashes in October. Let me pull up a chart real quick. So yeah, the market crashes October 16th. Then Monday, October 19th, was the largest single day fall in the stock market, I think, in history. Certainly the biggest decline since the Great Depression. But then the very next day, October 20th, so the very next day after the big crash, Alan Greenspan, the chairman of the Federal Reserve, came out and basically said that he issued a statement promising to provide liquidity and to support the banking system in the wake of all of this stuff. This is just another example of one of these catalysts, the Fed coming in and supporting the market, easing the uncertainty around this event. And obviously, it wasn't a V-shaped recovery. There was quite a bit of choppiness for basically the next year, but this marked the bottom. It could have been worse. I don't know. Maybe it was going to bottom there anyways. But the fact is that the Fed stepped in, announced their support for the market, eased a lot of fear about continued cascading declines, and the market bottomed. And for an example on geopolitical catalysts. So we're going to talk about the Gulf War in 1990. Was it, I think, August 2nd, August 3rd, you had Iraq invade Kuwait. Oil spikes. People are worried this could destabilize the global economy. Market just tanks over 20%. And then the resolution came in early January 17th, January 16th, 1991. The U.S. announces Operation Desert Storm. And what they do is the night before the market opens, they bomb the complete shit out of Iraq. And the reason this sends stocks vertically higher is because people were really afraid that this would be a long, drawn-out conflict that could disrupt the global economy. But once they see the effect of the U.S. bombing, it becomes quite clear that it could be over pretty quickly with direct U.S. involvement. That hope sends stocks shooting higher, and it goes on a 15% rally about a month or so. Then if we fast forward to 1996, the middle of the dot-com bull market. So if you take a look at, I'm just using the Dow Jones, but again, you can use the S&P or NASDAQ, doesn't really matter, in July of 1996. And the reason the market was falling was not because the economy looked terrible. It wasn't because earnings were slowing down, but actually it was falling because of the exact opposite. Earnings were great. The economy was actually so hot that investors were afraid that because the economy was doing so well, that investors were actually worried that because the economy was doing so well and that the job market was doing so well, that what would happen was rising wages would end up spiraling into inflation. So because the economy was so hot, they were actually worried that would flip and turn into elevated inflation. And if you take a look at the chart right afterwards, what ended up happening was you had some economic, I'm not going to pull up the dates right now, but you had economic readings showing that inflation was actually not going up, and that contrary to the market's worries, the Federal Reserve was not looking at rate hikes to cool the economy and to head off any potential inflation. On the first report that kind of eased the market's fears, you had the market shoot up, stabilize a little bit, and then on the second report, the market just totally took off. And then, of course, in 2008 and in 2020, we had economic catastrophes, which definitely obviously rattled the market. But then the Fed came in to save the day, basically, right? In 2008, you had quantitative easing, which supported the market. And then in 2020, you pull up a chart of the market, then you'll see that the very bottom of that fall in 2020, March 23rd, the Fed announced basically unlimited QE. They basically said, whatever it takes, we're going to backstop the market. And the market just absolutely ripped higher from there, right? If you were paying attention to that, you definitely could have capitalized pretty well. You literally would have caught the bottom. And then in 2022, basically up until kind of recently, or even still now, inflation has been the big thing, right? Inflation readings have been market moving events. Anything that the Fed does in relation to rate cuts, especially in regards to how it's going to affect inflation, this whole thing has basically been the story of the market since, 2022. Like we said before, the Fed has interest rate decisions all the time, every year, but not every single time that they change rates is a huge, crazy event. But when the market is hyper focused on rates or hyper focused on inflation, which, plays into interest rates and all that, that's when it does become market moving big deal, right? And sometimes you get one reading that'll be like, a surprise cooling of inflation and the market will react on that, but there's not any meaningful follow through from that time. Maybe the market goes into consolidation for some period of time, like we saw in 1996, and then we get another reading, maybe an unemployment report, or once it's CPI, the next it's PPI or something. And then on that second confirmation, the easing of the fears that the market has, then you'll see the market rip and have follow through. So sometimes they need multiple reinforcements to kind of ease their fears. And I kind of want to touch on one thing before I go ahead and try to wrap this up here. And that sometimes good news can be bad news and bad news can be good news. How do you determine when good news is actually bad and when bad news is actually good? Super confusing. You're not going to know all the time, but if you pay attention to the market's reaction, that'll give you greater insight into it. A good example would be recently, I don't remember the day, but we got some kind of economic readings, something about unemployment numbers, and they were much greater than the market was expecting. So that obviously sounds like bad news, right? Deteriorating labor market, too much unemployment, whatever. But the market saw it as a good thing because if the job market was doing poorly, if there was too much unemployment going on, that would be an incentive for the Fed to cut rates. So sometimes these things that on the surface can seem like bad news in and of themselves, when put in a larger context, can actually be positive for the market. And again, I can't tell you what is going to make a certain catalyst more important than the next. The biggest thing is to have some way to verify. And for me, the easiest way to verify these reactions is just to look at stock prices, right? Just to look at the market. I can't tell you when one catalyst is going to be, more important necessarily than the next, or if it's going to be important at all. But the biggest thing to be aware of is that there is a potential catalyst, and then to pay attention to the market's reaction to that, right? You could think that, the market is getting it wrong. It's not going to happen. You could think the market's going to go down. The market ends up rising. Maybe that could be a one day thing that happens all the time, right? There's a short-term reaction to one side, but then the fall through is on the other side, right? That happens a lot. But if you end up taking the wrong side and you bet against the market when the market is going, the other direction, that can be really, really dangerous if you don't know how to control your risk. The best thing is always, always, always to go with the market. And then if things change, then you can go ahead and change your position too. It's a lot easier to do that. Maybe you miss out on a little bit of gain that you would have had otherwise, but that's the insurance that you pay. You always want to go with the market. You can always change anything later if the market decides to turn, but you can't undo your losses. So let's try to wrap this stuff up. The market is a very, very noisy environment. Like we said at the very beginning, like 90% of what goes on in the market, whether it's the stocks themselves, the movement in the prices, or the news, the narratives that you hear, 90%, if not more, is just complete noise that you should totally tune out. And you need to find out how to siphon through all that stuff to get to what actually matters. The only way to get to what actually matters is by looking at the market, seeing how it reacts in the short term and the long or medium term to these certain catalysts. And again, there's more than what we just talked about here, but identifying these potential catalysts, how the market and the individual stocks move in relation to them, will help you cut down on the insane amount of noise that goes on in the market. So hopefully you were able to take something away from this. If you did, please share this with someone you think might get some benefit from it. And I'll talk to you guys next time. Thank you.